where are the markets at here? Not a big deal, down a little bit, recovering, interesting, all the, again, turmoil, tariffs, sanctions, so on and so forth. There's no doubt that those markets outside of the U.S. took a hit. As I looked at some of the country fund over the weekend, some of them got hit pretty darn good on their gap down, what caused our markets to gap down on Friday, but they got hit much worse. And we can take a quick look at the euro, which looks like it's going a lot lower. And so here our markets are still in an uptrend here, looking at the S&P futures. And, well, obviously it's very early in the day. We've got the beginnings of a bottoming tail, which would be just exactly the pattern that I would anticipate should happen based on a push to a new high and then a pullback. The beginning of last week, I guess it was, or two Mondays ago letters, I was thinking, well, we should see a new all-time high in the S&Ps. Reasonable thought based on the prior action that was happening here. Didn't quite get there and then started pulling back, and you know what happened on Friday. So now we'll see where this ends up, whether it holds this area and getting a bottoming tail or whether it goes lower. If that's a red bar by the end of the day. And every day we don't know where it's going to end at the end of the day. As we get closer to the end of the day, especially around 3:30, it becomes pretty good odds that it's going to end about where it is at that time. So we'll see. You see the hourlies are in a downtrend. They popped up here, up at some resistance. We'll see if they can hold on to that. Now, when I see a daily chart like this, I like to see the hourly chart start going sideways. That's a high odds trade to take as a swing trade and a day trade type of opportunity, because now you have time frame alignment where that hourly chart starts basing out, which would typically mean that by the end of the day, it could be basing, or you get another day of consolidation there, which is even better, where you have, 2.5 days, sometimes 3 of a sideways move, and then it pops. And it's somewhat similar. Well, it is similar. I mean, we're looking at different time frames. You remember on Friday, we talked about where near the end of the day, the spiders were coming down to retest, actually break through the prior low, and we were anticipating a turn. And if you go and look at that 5-minute chart, you'll see 3 bottoming tails just before it broke. So the same idea, different time frames where the turn happens after a few bars versus 1 bar. When it happens on 1 bar, a lot of times it pops up, it pulls in a little bit, makes a higher low. As long as you have an adequate stop, it'll be just fine. So that would be the case here, assuming this was closing this way and it triggered, it would probably push up, come back down, jiggle around, make a higher low, and then go. So a lot of anticipatory price action as to what may happen, but I explain that so that it kind of helps you with understanding price action and how things set up when they set up really well versus maybe they don't. All right, Qs holding up here so far near this prior new high reversal, going sideways at a prior high is bullish. We'll see if this holds up here. You can see the hourly looks pretty much the same as the S&Ps. So the markets are bullish, no doubt. Are they going to consolidate here a bit, waiting for some more information? I think that's reasonable to think, more negative news where selling comes in, or maybe the news isn't such a big deal and the markets resume and push higher from there. We'll see. Dow a bit weaker, but again, buyers stepped up on the dip. Good morning, Jerry. Buyers stepped up on the dip. You can see the depth of retracement here is deeper than the S&P, which is quite far from that prior low. It's actually what we call minor support, whereas the Dow is coming down toward major support. The buyers are stepping up. Good morning, Larry. And so we can just see by eyeballing retracements that the Dow is showing relative weakness to the S&P. as well as the NASDAQ. Bonds retracing a little bit. So based on the news last week, we saw money flowing into bonds, which pushed interest rates down, which is what we really don't want to see happen in any significant way, since short-term interest rates continue to rise in anticipation of the Fed continuing to raise interest rates and the risk of a inverted yield curve. It's not there, but we don't want to see bonds pushing up significantly, because as bond prices then go down, it increases the probability of that yield curve inverting. Oil has been a little wild. It had this nice move up and it's pulled back here. I'm not sure that this is a breakdown failure yet for obvious reasons, but we'll see if it does or whether it actually breaks. But the oil ETFs, which had done well and looked great, they're just chopping and going nowhere. So maybe they're just waiting to see what oil does. But day to day, they kind of, they're going to recover. They're going to go up. Oh, no, they're not. They look like they're going to go down. And when they trade that way, what do? Well, we go out to longer time frames and see if it all makes sense. So that's a general, rule of thumb as to if the time frame you're looking at is erratic and not making sense, go to a higher time frame and see if it does make sense. And so if you're looking at a daily, you go out to a weekly. If you're looking at a 5-minute, you can go to the 15-minute or the hourly and see if it makes sense then. Gold just continues to drop new lows here. Why anybody would want to buy this is beyond me, or bet that it's making a low, whereas Dan sent me last week some service is betting on it making a low and putting on some option spread trade, which was just ridiculous. Anyway, that's what makes a market, right? Euro, you can see the drop here. There's a little stabilization today, which means the dollar continues to strengthen. And so this does look like it's going lower. As we go out to a longer time frame, you can see what I mean. Forget the moving averages. What we have going on here, I wrote about this in the letter over the weekend, is this head and shoulders top. And so now it's broken, which suggests, a move, which always, comes down to some support anyway. But that's the head and shoulders top projection analysis, where the depth of this size of the move here projects downward and so on and so forth. But in any event, you can see it tried to hold that level and it's broken, which suggests it's going to move lower. Will bond will affect short-term interest rates or long-term? Well, David, there are short-term interest rates and long-term interest rates. So if we look at short-term interest rates, they've been going up for a couple of years now. And, well, here's the 5-year. That's the 5-year, what you can see. That's 5-year yields. But if we look at 3-month yields, which is most closely correlated to what the Fed, anticipation of what the Fed is going to do, you can see that they've been actually going up since 2016. So is the Fed going to raise interest rates? Well, the bond market sure believes that they're going to. That absolutely for sure. They haven't moved as much as this, but again, markets move in anticipation of something happening. Now, note that the level here, 0.2. So if we look at the 5-year now, 2.74, pretty far away. Now, what happens if these yields start coming down, which is what we don't want to see, and they move under those short-term interest rates, you're going to have a yield inversion between the 3-month and the 5-year. And then eventually, what happens is here's the 30-year. The 30-year, which is relatively far away, eventually moves under the 3-month, or some people look at the 10-year versus the 2-month. All of these tend to happen together. You're going to have a recession. And then that's going to drag the stock market down in a pretty big way. Historically, that is what happens. So you want to keep an eye on that. It doesn't change too quickly. And checking it week to week. This makes sense to me. Well, no, the Fed controls the Fed funds rate. They don't control the 3-month interest rates. The market controls that, but the market will move that in anticipation of what the Fed is going to do. So you can watch the 3-month, the IRX, and you can see that they continue to trend up. And that implies a very strong belief that the Fed will continue to raise interest rates. And if you look at the longer term ones and you start to see them dropping, that the implications of that is that the market believes that the economy is going to weaken. There is a very anemic demand for money, and that all comes together in our intermarket analysis. And we know historically when that happens, there's going to be a recession. It happens every time. It doesn't happen too often. It happened in 2000, end of 2000. It happened in 2007 into 8 and before that. So, and big drops in the market. So we keep an eye on it. I report on that in the letters as it happens. And so compare, I'm a 30-year. Yeah, you can compare the 5 against the 30. I look at the 5 against the 10. I look at the 3-month against the 30. Just kind of the 3-month against the 5. Most of the time, the very short-term ones will invert before the very short to long-term ones. So yeah, but it happens really slow. And even when it happens, it's going to take time for the market to really take notice of it. It'll seem to take notice because you'll hear it in the media, but then the market won't go down immediately. It's just the way it is. All right, so there's the markets and spiders, as you can see. Let's move that to a daily. Yeah, you can this isn't live, but it's trying to hold here, and you can see it's same as the futures, but sometimes it gives us a different view of what's going on because of the gaps, whereas the futures are trading 24 hours. And same consolidation going on here, and the markets are, they're being bought here. Concerns this week are definitely this internet index. We talked about this in the room at the end of the week. A lot of stocks that look similar to this, whereas it's a sell setup where it's retraced back up after this crack. And one of the things to look for, does it break through here and drag markets lower, or does it get above Thursday high, which will start a short covering rally, I believe, and push things up. So it's one of the themes that we're going to be looking for this week. Index and trade station. You probably have to put .x, Brian, after the X. A lot of times they do that. You can try .x. And so a little gap up here. It was down in higher technology. Didn't get hit as bad. More diversified index. So technology gap down on Friday, and we'll see if this can recover. That's what we're going to be looking for early in the week, whether these can recover. We do have some earnings coming out. It's about the end of earnings season here, so a lot of retailers coming out this week, and you can see the hesitancy as it pushed up to new highs there out of this base, and we'll see what happens in retailing. We'll keep an eye on that. Lastly, I'll let Dan come on. Transports actually pushed up above the prior high. It's pretty far from that all-time high, but another good sign to see the transports taking out that resistance and recovering from that nasty crack. So that's it. Hope it all helps, and we'll see how things unfold here as we go through the trading day.